Hi, my name is Harris. I'm one of your podcast hosts. I'm also a lawyer at Treadstone Law. For most Canadians, buying, selling, or refinancing real estate, a lawyer is the last thing on their mind. That's unfortunate because lawyers play a vital role in the process. But what choices do Canadians have? Lawyers can be very expensive. Well, Treadstone Law offers resources to Canadians so they have access to the information they need. Whether you sign up for a live workshop or a mailing list, we cover topics to help you make informed decisions and avoid costly mistakes. It's advice you can start using today, and best of all, it's free. Visit treadstonelaw.ca/MAS offer or click the link below to get access right now. If you're looking to retain Treadstone Law, it's never been easier. Our entire process is online. From completing the retainer agreement to your signing appointment, everything is done from the comfort of your own home. We're your digital lawyers. The best part of it is that you don't pay anything when you're retaining our firm. Visit treadstonelaw.ca/MAS offer or click on the link below to retain us right now. Enjoy the podcast. Welcome to another episode of Hustle and Grit. On today's episode, we've got Josh Perez. Josh is the principal broker and partner at Synergy Mortgage Group. He originally started in banking and transitioned to the broker channel in 2015. He's been recognized in Canadian Mortgage Professional's top 75 brokers in Canada each of the last 3 years. His brokerage, Synergy Mortgage Group, which officially launched in 2022, has just been nominated for Top New Mortgage Brokerage of the Year and funded just over $500 million in mortgage volume in 2021. Josh is also actively involved in real estate investing and presently owns 50 plus stores spanning residential and commercial property mainly in Ontario with a few active projects in Southwest Florida. He started his investing journey in 2010 and is a big advocate of helping his clients, partners, and inner circle building wealth through real estate and educating them on how it can help them accelerate reaching their financial goals. Welcome to the podcast, Josh.
Wow, thanks for having me here. It's quite the intro and bio. You captured the meat and potatoes of me and what I got going on, so appreciate it. That's cool.
Yeah, I mean, safe to say with that bio, you've got strong experience in the real estate industry.
Yeah. You know what? But despite having experience for sure. I mean, there's always things to learn. There's always different things happening in the industry and changing. So still a lot to grow and develop for sure.
So just to kick things off, what got you into mortgage brokering? What kind of pulled you into that kind of realm? Because you've been in banking, and then from banking kind of moved into mortgage brokering. Like, what got you into that area?
Yeah, so the mortgage and the real estate investing really are kind of tied together. So, I started working at the bank, shortly after finishing university, and that was in like 2009. And, in 2010, I had, a couple buddies, and we always talked about, wanting to start a business. And, we'd meet like every few weeks, talk about different business ideas. We got on the topic of real estate. Attended, Real Estate Investors Network conference. And then from there, we just got hooked on the real estate investment side of things. And so bought our first rental property in 2010. And it was right like after that purchase where I started to kind of decide that, with my banking career, helping people with investments as well as mortgages, I really wanted to kind of gravitate and specialize more on the mortgage side of things, which is tied to real estate. And then, learned about the mortgage brokering channel where, we can work with banks as well as all other lenders, credit unions, mortgage companies, can really be a specialist and master of that craft. And again, it's tied to real estate. So that's kind of how the transition from banking to mortgage brokering specifically happened. But it was all kind of tied and inspired by the start investing, what I felt, I was seeing that, could accomplish with that financially.
So with the investing part, were you an avid real estate kind of guy in your university days, or was it something that, you're out and you're like how did you get into the investing part of the?
Yeah, you know what, actually, haven't thought about that too much, but now that you ask me, yeah. So again, what ultimately led to taking action with an actual purchase was, a group of two buddies and talking about
Yeah.
starting and got on that topic, started like opening up a joint savings account. We were literally like saving for probably like over a year, just
Yeah.
biweekly paycheck to build up a down payment fund. But prior to that, I think I was exposed a little bit to real estate through my family. My dad, my uncle have always been entrepreneurs and had invested in real estate. And so, it's always kind of caught my eye, what was going on there. But
Yeah.
it was, maybe a combination of that, as well as just kind of learning through the process and attending my first conference and learning about, um,
Yeah.
long-term real estate investing.
Yeah. So, safe to say or assume, I would say that a significant portion of your client base are investors. Is that right?
Yeah, you know what? I would say we're probably, I mean, for each of us partners, it's a little bit different. I'd say for me, I'm probably like 60 to maybe a little bit more than 60% of the clients I help, their mortgage is associated with something to do with real estate investing. So it could be, a mortgage associated with their primary residence, but they're
Yeah.
looking leveraging equity, setting up a home equity line of credit in order to purchase and invest in real estate. But yeah,
So is
it's
that like
only
first time investors? Sorry, not to cut you off, but is that
yeah,
first time
no, no.
investors?
Yeah, I'd say we have a really big mix. So of first time investors, people buying their third, fourth property. We have some clients who are buying like their 10th property. So
Yeah.
kind of all along the spectrum. But right now we really are trying to. I'm trying to spend a lot more time educating people right now. With inflation and
Yeah.
dollars being worth less and less. With long-term real estate and rental properties, being able to achieve a rate of return long-term of 25 to 40%, we're really trying to open up people's eyes to, using equity that a lot of Canadians have built up in their home over the last few
Yeah.
years and really putting that to use.
Yeah, I mean, you said it in a very interesting way, and this is the first time I've heard somebody else say it because that's how I like to phrase it. But you said the
Yeah.
dollar is worth less and less. You're not saying that the real estate is worth more, and I feel like a lot of people kind of get that confused. I feel like with just the economy and how like it's going and the quantitative easing and all of that. It's really the more people who are more in banking and finance that will understand that it's not necessarily the property that's worth more. It's that there's a lot of dollars that are being printed off, which is diluting everything because everything is going up, and how to hedge against that. So it's extremely interesting. I just want to like then kick it off into, if I'm a first time investor, right? And I'm coming to you. What's the process like working with you? What is it? Do I just give you a call and say, "Hey, Josh, I need a mortgage," and then you line it up, or like, what's the process? Walk me through the process.
Yeah. No, good question. I'd say that whether you're an investor or someone looking for a mortgage
Mm-hmm.
for their own home, or they're for selling and buying, it all starts and to a certain point is the exact same process. Obviously, the plan and the advice is going to be different at a certain stage, but early on, really what it is we look at setting up what we call an opening call. That's
Mm-hmm.
typically first step in the process, where it's literally just we schedule a 5-10 minute call. Sometimes it's longer, but usually it's 5 to 10 minutes.
Mm-hmm.
And really the purpose of that call on my end is to get to know the client, a bit about their financial picture,
Mm-hmm.
where they're at in the process, and what they're looking to do. And then so that they can kind of paint a picture of where their goals are at, or possibly if they don't know what their goals are, letting me help them build a vision based on their financial picture. And then I'll also talk about what our process is, set the expectation on timelines and service, and some of our team working with a client. Then step two is really sending a request based on our conversation of certain documents that
Mm-hmm.
we need in order to assess and pre-approve or build a plan. Once all those documents are all back to us, we're usually pretty quick. Within like probably a couple days, I would say 1-2 days, we'll be reaching out to set up our second call. That's kind of like our pre-approval, our
Yeah.
planning call, where we go over all the high level details based on what you told me was important to you, what you're looking to achieve, and about your financial picture. Usually include, a few spreadsheets and then we'll go through some high level numbers on both, qualifying and like illustrating like a budget associated with what you want to do.
So for the pre-approval, can you walk me down that kind of area of that process? Just because nowadays, whether you're investing or whether you're buying, it's hard to get like a financing condition in. You're going to have to go in firm. And even though I always advise my clients throw in a financing condition, but sometimes the market doesn't let you, right? And when you go to like when they go online and they see these 60-second qualify everything, and it's not really like you're getting anything real there, just because in 60 seconds the calculator says you can afford $1 million doesn't really mean you can afford $1 million. So what do you do to kind of pre-approve the clients, and is that kind of enough confidence, you'd say, to go in for a firm offer?
Yeah. So the reality is this, traditionally, and when I say traditionally, it's probably like more like prior to maybe the last 5 years, writing an offer traditionally in real estate would like almost always come with condition of a home inspection, financing, which, ultimately allows people to have like an out, right?
Yeah.
Accept an offer, but they still have a little bit of a time period to walk away if they don't like something, don't feel good about it, something doesn't work out. Nowadays, obviously, as a result of there being so many buyers, so much demand, and not enough supply to service the buyers, obviously we have, more and more people bidding on fewer properties, right? And as a result, sellers can kind of pick and choose what's in the best interest of themselves. And typically, if you have an offer, for $500,000 or $1 million with no conditions, and one with two conditions, you're taking risk off the table, right? So the reality is just, you can write a condition, and that would take a lot of pressure off of myself, the home inspector, the contractor, the real estate agent, right? If you had that built in, but the reality is like we can't truly help people unless we can kind of advise them on going in firm. And there are some risks, but we can mitigate most of them with a team and a good real estate agent, right? So on our end of things, to answer your question, like a pre-approval, not all of them are made equally, right? So you can go to 4 different people, a bank, a broker, a couple of brokers, whoever, and their process and what they obtain from you in order to advise you what you're pre-approved for can be very different. So number one thing is a pre-approval is only as good as how thorough the person was with your financial information during that process. And secondly, how well versed they are with lenders and policies. Because what a lot of people don't know is that, pre-approvals is just, it's a hypothetical assessment. The application typically does not get reviewed and cannot be reviewed by a lender, right? So the person interpreting the application really needs to know, your financials inside and out, as well as the lender's policies, right? What often gets talked about is like, people associate like a timeline or a hold sometimes associated with pre-approvals. Oh, my pre-approval is good for 90 days, 120 days, so-and-so. The pre-approval is not held. Some lenders will allow you to hold a rate, but the rate will be held, but your file will still be reviewed. So like if I pre-approve you, Harris, today to go buy $1 million house, and then tomorrow you go out and go lease a Lamborghini for $10,000 a month, right? Yeah, your financial picture is going to change. Or like something unfortunate might happen, right? And your financial picture has to change. That again is going to be reviewed later on with job changes, stuff like that, right? So the other piece is like the property, right? There's no property at the time of a pre-approval. So that's part of what a lender reviews sometimes in an appraisal. And, the real estate agent that you're working with is very, very important to understand. Sometimes we have, just like in any industry, lawyers, brokers, bankers, real estate agents, you have really good, really experienced ones who want to understand everything in their business. And sometimes you don't, right? So sometimes we'll have like real estate agents ask us, can my client go firm? Can my client go firm? And our first question is like, on the financial side, they're good. Like, can you confirm that you've reviewed the comparables of the sale of properties in this area? And do you estimate this appraisal coming back at the same value, right? That's a key part of it too, right? So fortunately, this has been the case now for quite a few years, and our team has a lot of experience working and advising clients on this. And sometimes, a lot of times we're completely good, to set them on their way. Other times we got to just paint a scenario of, okay, you know what? we're very likely to get this exception. We feel good that it's going to be okay. But worst case scenario is this. But we still feel very confident about it. And, knock on wood, whatever. Our team and over the last like 5 years and, 1,000 mortgage transactions, like we've been good in the space, but it really comes down to the person you're working with and the collective team that's in sync with their special kind of expertise.
Quick 10-second break. Are you finding this podcast useful? Do you want access to more resources just like this podcast? Sign up to one of our online workshops or our mailing list, and we'll send all the information you need right to your inbox. Good advice is hard to come by, especially in a market like today's. Sign up by visiting treadstonelaw.ca/MAS offer or click on the link below. Enjoy the rest of the podcast. I mean, that's what I always tell anybody asking me for advice. First of all, always put in a financing condition if you can't do that. I just feel like, I'm not knocking on the banks. Banks can't really help you. They don't typically look at the file until you put in an offer, and then you don't really know what you're getting. And even with mortgage brokers, you need to have enough volume to understand the different lenders and their underwriters, build those relationships, and kind of understand this is their risk profile. Because a lot of times it looks like it's the same, but really, I wouldn't know. You would have a better idea if you're kind of working with different lenders and you're submitting them files that appear to be what they say they accept, but there's something there that is not that they don't like. Their risk appetite is not for a certain aspect of that deal, which is I always push people to brokers. So, and the other thing is also when you're I think I completely lost my train of thought. So when, for example, with people who are self-employed, they'll go on the qualifying calculators and they'll put in maybe their revenue, or they'll put in whatever it is, and every single dollar is not worth the same. You have to look at what exactly are you earning, and then let's say you need to qualify for a higher amount. Sometimes people are like, well, you know what? I need to go to the A lender because I want the lowest interest rate. Well, do you want to kind of show more income so that you can get the lower rate? How does that trade-off work, right? How often do you get that kind of scenario?
So you mentioned a couple of things there that actually are really good and can lead to really, really good advice for a lot of people right now. But first on the calculators, you know what? They're a very convenient and quick tool. They're very, very dangerous. They're very, very dangerous because they're only as good as the person's inputs. And how would someone who doesn't work in underwriting a mortgage file know, what the proper inputs would be? I mean, if you have, 2 salaried people with no debt, something to that effect, there's not too many variables in that space. But for most people, there's a few variables here or there that on the back end, a lender interprets. If you took 5 different lenders, they have a different policy on self-employed income, or, full-time income with a bonus that might've been different last year or this year, right? There's more income to be used, but it might be treated differently. If you have a student loan or line of credit that's on repayment, not on repayment, again, those are variables that change things. So moral story, they can, it's not to say they're never accurate, but for most people who don't have a very simple salaried zero debt profile, what the actual approval amount behind the scenes once it actually fully gets audited can be very, very different. The one thing about self-employed clients, that's really good. You know what? That's a really important space where, I think our team really excels at in just painting a picture and options for clients, right? Because, most business owners, when they open a business, there are some tax benefits, right? Obviously, business owners take on a lot of risk as well. Mm-hmm. And as a result, there's some tax benefits in their business on revenues that they receive. Typically, most business owners aren't pulling every dollar they earn out of their business to the personal level and claiming it. Could show, maybe a higher income, right, than what they're actually earning. And also, most accountants don't advise them to do that, right? So as a result, until, maybe an entrepreneur or business owner has a conversation that involves, a mortgage, this kind of thing might not come up or come to the forefront of planning, right? So a lot of our self-employed clients, we recommend that they connect with us prior to filing their tax returns so that we can paint a picture for a few different scenarios. And I do this with my account. every year. I said, hey, you know what? Business looked like this. Give me 3 different tiers of what I can claim and what the tax liability is going to be associated with it. And then on the back end, I'm going to go look at how that impacts, a couple of mortgage scenarios, refinances, purchases that I want to do this year.
Okay.
And then I know what qualifying looks like. Or on the flip side, you don't pay all that tax to CRA potentially, show a lower number, and then you just got to work with a different lender that might have a higher rate and maybe some fees. But really what it comes down to is math, right? CRA taxes, interest rate, and fees. Do the math on both. Can we achieve buying a property with an A lender or with a B lender? Oh, at what cost? Or do you scale back what you can qualify for on the A side? Can you still find the right opportunity? Yes or no? Obviously, you always want to gear towards the A lender, right? Better terms. But if it doesn't allow you to achieve purchasing the asset that you need to at a certain price point, then you might have to look at, another scenario that maybe it yields, a higher interest cost and some fees, but your bottom line and growing your net worth still supersedes that additional cost, like 100x.
Yeah. No, I mean, you've said something really interesting, and I've never heard this before. So I want to kind of ask you a little bit more about that. You said that, and I'm assuming this is for your investor clients, before they're filing taxes, to come out and then and tell you how. Do you get in touch with their accountant, or do you get in touch with the client themselves? What do you have, do you set up a meeting? What's that process like? Because oftentimes what I find is, especially for self-employed, especially for investors, it's more of a reactive game where, okay, well, I've already filed this. Now it's up to the mortgage broker to take that and figure out whatever they can do for me.
Yeah. And don't get me wrong. Listen, my goal is always, and our goal, I say as a team, because we work very well in sync, is to try to give people as many options as possible. Don't necessarily advocate, one or the other. We will based on understanding our goals, but give you as many options so that things don't get ruled out, and then you make an informed decision. You might still do whatever you want to do anyways, but most business owners would appreciate knowing, hey, if I claimed an extra $25,000 in income, which equates to another $8,000 or $12,000 in tax. I'm just giving a random number. $12,000 in tax, I can qualify to buy a property that's $150,000 more.
Yeah.
That can move the needle potentially with what's available, right? So what those conversations look like, Harris, it's pretty flexible. Usually what I'll do is, I'm chatting with you, right?
Yeah.
And I'm like, okay, what do you plan to do this year? So we're probably at a time now where maybe you have, or maybe you haven't filed your taxes, but it's around that time where things are moving, right? So I'm like, okay, well, I'll have your information for 2020 and 2019, let's say, right? And after a certain point, lenders will really only work with 2021, anticipate, right? So if we're talking right now and you're like, okay, I want to get some things ready, I want to buy a house, it could happen in the next 3 to 6 months. Okay, at a certain point in that 3 to 6 months, lenders are only going to work with your 2021 taxes, right? So usually what I'll say is, hey, for some business owners who don't T4 themselves, they get paid dividends or other income. I'm like, hey, what do you anticipate? What do your financials look like in 2021? Were they similar to 2020, lower, higher, the same? Most business owners know relative to that. Yeah, it's around the same, or I kind of got stuck with, COVID and a few limitations. It's going to be a little bit lower, or I killed it. It's going to be much higher. So I first start with just a sense of where we're going to be, right?
Yeah.
And then what I'll do is I'll work with that. And I'll be okay. Well, assume that we do the same or a little bit less, or a little bit more. This is what we can qualify for this year. And you're going to be like, oh, great. You know what? You said I'm qualified on the A side bank to buy $1 million property. Great. I'm good. But I actually want to buy 2 properties this year. I want to refinance one. I want to buy that one. And I want to do a couple other things and maybe buy another one at the end of the year. Okay. Well, Harris, you're good up to, $1 million. And then if you refinance this one, pay off some of this stuff, we could probably do 2, but on that third one, I think, depending on what the rental income looks like, we might be a bit tapped, and we'll still run through that scenario.
Yeah.
However, here's a couple ways where, again, you give me the info. We go pretty deep on these hypotheticals.
Yeah.
Tell me what that next property price point could be. What can the rental income or the unit breakdown? We get pretty far because all those details matter, but a lot of clients really appreciate it. And then ultimately I'll say, okay, well, you know what? if you grossed this amount, right, and you only want to net it here, you know what? If you net it to this number or that number, that'll get us that third property this year. So just so you know, otherwise, if you really don't want to do that, or sometimes like you can't based on what your business generated, I'll just send you a separate spreadsheet of like, okay, if we have to go to like a B lender with a slightly higher rate and fees, like this is what it would look like. Does this deter you from wanting to buy a third property that may generate 25 to 40%, long-term annually? Most people know, but again, it goes back to us wanting to illustrate the picture so that everything's in front of you, and then you can make the informed decision on maybe paying more taxes or just not paying more taxes. And you're like, okay, you know what? I know what this is going to look like when I'm analyzing the property. I'm going to build in my interest rate at 3.5% or 4% and not 2.5% or 2%. Right.
Yeah.
And the numbers, if it's, if you're looking at a cash flowing asset, a multi-unit property, usually if that difference between an A lender and a B lender's rate makes the property no longer desirable, in my opinion, it was probably too close. For comfort. Right. The reason. Honest with you.
No, I mean, that's it's prudent. I feel like again, like a lot of the deals that I see for investing, especially for first time investors, people aren't looking at the entire portfolio. They're not looking at 2-3 deals out. They typically go in for that first investment and they're like, give me the lowest interest rate. That's the only thing that they're looking at. When if you look at like the entire portfolio, maybe the lowest interest rate isn't the best idea because of certain aspects of that mortgage will prevent you from getting that second or third property.
100%. You know what you're talking about. That is 100% true. But you know what also is like, on the flip side, on clients or first time investor side of things, it's just a thing in our culture, right? And in our education system, like, why would you expect, someone who hasn't gone through this to think otherwise, right? Because we're not taught these things in school. We're not taught about credit or real estate investing or leveraging or, what a reasonable true rate of return is, like when you factor in inflation over the long haul and what can be achieved, right? So those are normal questions. And we always tell our team, hey, listen, just because the client is, so fixated on lowest rate, it doesn't make them a bad person. It's just they haven't been exposed or educated on some other important factors in the financial transaction, right? And don't get me wrong, we're always looking at, like, you tell me your goal, Harris, and we start with who's the lowest rate lender that you qualify with.
So
it could be like, Josh, I want to buy a house for $1 million, or the investment property that I want to target is I need to be at around $1 million. So usually we come back with, hey, Harris, this is what it looks like. This is what your qualifying looks like to purchase $1 million house. And that rate might not be a lower rate. We could also come back and say, Harris, here is the lowest rate you qualify for. And it's a purchase price of $700,000. Most people want to see, like, fit the goal, not change the goal to fit the rate for the goal, or I don't know. But you know what I'm saying.
No, I get it, and I completely agree. I think a lot of people, I mean, it's not even just that. I feel like a lot of people are miseducated in that they think that they know mortgages. And I'll be the first one. I look at mortgages really from an outsider. Being a real estate lawyer, I'm looking at them as they're going through the firm, and we're kind of doing the legal end of it. But I still don't. I'm going to be the first one to say that I don't completely understand all of them, and I deal with them majority of the day. Like, there's insurable, insured, uninsured. There's so many different things. A lenders, B lenders,
don't know that.
right? So when they go in and they're like, you know what, I want a fixed mortgage, and I'm like, do you really want a fixed mortgage? Because from what I know, like, the breakup penalties are so much higher, and to pay, like, to have that variable. First of all, like, the interest rates are lower, so I feel like it's a no-brainer. But there's an optionality of you could break it because life happens. Nobody, I don't know if it's a majority, but decent amount of Canadians don't see their term through. So you're going to be breaking it, and the banks know that.
Yeah. Man, I don't know if you're watching my videos, you just know this stuff. If you're ever looking to add the mortgage career in your space, like, things you're talking about are, like, really, like, the hot button topics we really talk about with our clients to just, again, give a different understanding of things. And the fixed variable rate conversation now more than ever, we're having with people. And again, The easy thing to do, which a lot of people do in this mortgage industry, is just path of least resistance or be an order taker, right? And could probably save a lot of time doing that by naturally most people are, or their parents or people who might be a little bit older, advise on the fixed rate. It's always the perceived safest, mortgage product. It's always referred to as like the standard, but the last 40 years, almost every 5-year rolling period, the variable rates outperformed it. It's just this narrative, which, a lot of things in the media are painted not necessarily accurately, that like variable rates, move up and down like penny stocks, and people's payments are going to fluctuate by like $500 or $1,000 a month, which isn't the case, right? And the penalty part of it, that's the biggest thing that is the biggest thing that doesn't get talked about. And we see it every day when people want to sell a house and buy that, no one explained to them the difference in fixed and variable rates and your limitations with a fixed rate, and how the penalty is typically 4 to 5 times higher the variable rate, right? Talking about, obviously it depends on the mortgage size, but you could be talking about the difference regularly we see $15,000 to $25,000 penalty versus like $3,000 on the variable. If someone wants to sell, break, needs to go to another lender, on their next mortgage, or there's a better rate, or they just don't qualify. So that's one thing people don't, and again, it's not their fault. They just don't get explained to this by the person who doesn't go deeper in their conversation of, is a fixed rate really more suitable for you? Or did you just ask for it because that's all you've heard about, right? We're like, no, guys, when we talk to our team, listen, we have to invest the 10 to 15 minutes sometimes for that conversation on fixed and variable and sharing stats and what we see every day, because, that's our job. If you ask, what's different about Synergy Mortgage Group and myself and our team, is we just go a lot deeper with our advice and planning with clients. We're very, very thorough because we really want to get down to what's the right solution for clients. The reality is just, anyone can do a mortgage transaction, collect, some documents, submit it, approval, but it's packaging it up for what the client's actual goal is and where they're going in the next, few years with things. Because, that asset that also comes with their largest debt, has some implications with it financially that could kind of shape which direction you might want to go to with another project or building your wealth. Or whatever goals that can be accomplished with, equity you have in that property, which is for most people their largest asset.
So shifting conversations for a quick second, moving over to market, because we're talking about fixed and variable. I mean, we've got a lot of conversation on, the Bank of Canada raised the interest rates 25 basis points. Everybody's like, oh my God, they're going to raise them another 7 times. I know this is a bit of a crystal ball question, but where do you expect interest rates to be December 2022? And this is recorded, so.
Oh man, yeah. I wish I knew. So there's probably just, and again, so one thing is what the climate is like today, and sentiment for where rates are going to go can quickly change with world events and things happening. We've seen it before, right? I would say, I think there's another rate announcement in April, so a few weeks away. As of today, the sentiment is that they're going to raise them again. So that would be the second increase in a relatively short period. So during COVID in 2020, spring 2020, there were 3 emergency cuts. Okay. 3 drop. Okay. So if we see one more in the next few weeks, we're still not quite at where we were pre-pandemic. Okay. So that's just one thing to just keep in mind. So, crystal ball, I would say from today onward, I could see maybe 2 to 3 more. Okay. So a total of 4 rate increases, or 1%. As a variable rate. And I wouldn't be surprised if it was less than that. I wouldn't be surprised, right? But I'm thinking as of today, where it's looking, that's where it would be. Do I think it could go up, 5, 6, 7? I don't think so, but the world is a very crazy place right now. Told me that all these things that have happened in our society, in our country specifically, the last 2 years would have happened, I would have said, absolutely no chance in
Yeah.
Canada. Here we are. So we
Mhm.
try to make decisions based on, what's in front of us. And I think, with rates, they impact your monthly payments, right? So what we do, we don't know where it's going to go. Would you prefer to just take a rate that's 1.5% higher today, which is the equivalent of 6 rate increases? Okay,
Mhm.
you could have today, and you're knowingly paying a higher interest rate, and you're knowingly exposing yourself to a penalty that's 4 to 5 times higher than what you could have with a variable,
Yeah.
and you know that about almost 70% of Canadians break their mortgage at the 3-year mark. We just kind of lay it out that way. And, we trust me, like, we don't say like, you're not crazy for taking a fix. Part of it has to do with how you sleep at night.
Yeah.
And every time you're blasted with a notification on Instagram or your Globe and Mail or the
Mm.
news, like, are you going to have a reaction? Are you going to be physically and emotionally okay every time you see that? Because some people like just got to be true to themselves. They're not okay with that. So you can just take a higher rate, higher payment, but it's going to stay the same. And maybe that's the comfort, you need, and you just build it into your plan. And if you can afford it, then that might be the right solution. So that's kind of how we kind of present it and illustrate it for clients so that they make the most informed decision.
Yeah, no, I mean, sometimes when I'm looking at it, and it's a very valid argument. When I'm looking at it, I'm like, why would you pay more on a fixed, just because you're afraid that the less is going to become more? So you're already bringing yourself up there. But
Yeah.
what you're saying is very valid. At the end of the day, it depends on your own temperament as well. It's not just the interest rate. It's like your sleep at night, and so if that's worth the fix, then yeah, you don't want that stress. So
100%. Yeah. You just made me think of something on that note. Um,
yeah,
Lost me.
yeah. No, I mean, yeah. That kind of wraps up the podcast. Thanks for coming on. Really had a pleasure talking to you. If anybody wants to get in touch with Josh, I'm gonna have his contact information below. Thanks again, man.
No, Harris, thank you so much. I really appreciate the time and getting to know you a little bit more here. And it was really cool. You know your stuff, and clearly, like, if you're helping clients around, the legal side of real estate matters and other legal items, you definitely clearly have some experience with other things that are involved, in their world, in the transaction. And I think, that's a very, very important quality for anyone advising on anyone, knowing a little bit, not advocating that they know everything in the lawyer space, the accounting space. You got to know a little bit and defer,
Yeah.
but that's really good. And thank you so much. I really enjoyed chatting with you, Aris.
Thanks, man.